Good afternoon, ladies and gentlemen. Welcome to this special episode of Market Masters. This is an episode that is directed to create wealth and create wealth in the easiest possible way. Our guest today is Mr. Mahesh Patil. He's the Chief Investment Officer at Aditya Birla Sun Life Asset Management Company and the fund manager of a fund called Aditya Birla Sun Life Frontline Equity Fund. This fund was set up in August 2002 and it celebrates its 23rd year of inception with a CAGR return of 19.77%. This, ladies and gentlemen, is the second best return over 2 decades. There are only 28 funds in India that have an investment history of more than 2 decades, and among them is Aditya Birla Sun Life Frontline Equity. A very warm welcome to you, Mr. Patil, and what a pleasure to host you on this subject. It's really interesting to note that since October 2005, when Mr. Patil joined Aditya Birla Asset Management Company, he's been associated with this particular theme since the last 19 years. Mr. Patil, what is the secret sauce of this wonderful performance?
Yeah, let me first thank you for inviting me on this show. I think it's always a pleasure, to talk about fund management and in terms of how, we've been able to really create wealth for our investors, right? So as you rightly said, this is a fund which, one of our flagship funds, right? The largest funds in the Birla Sun Life Asset Management Group, and this fund has tested the times, various markets ups and downs, and is able to scale up. I think primarily because of the consistency of this fund, right? So while
Yes.
it has its period of ups and downs like any other fund, but it's been able to bounce back from those periods. And as a result of that, we've seen the long-term performance of this fund has been really in the top decile, as you mentioned over here. So since I've been managing this fund now for almost 20 years, right? Okay, since October 2005, I would say that it's been a learning phase for me also while managing this fund, right? I mean, this is a fund where I've learned through the various mistakes I've done, during that journey, and I would like to share some of those things in terms of what is it, what has worked and what has not worked for me, for which can be probably useful for any aspiring fund manager. So I think one reason for the success of this fund is that, as I said, it's been consistency, because that's what people want, right? So out of those last 18 or 19 years we've been managing it, 75% of the times the fund, 80% the fund has beaten the benchmark, in any calendar year if you look at it. So we try to do, and that has come in through ensuring discipline, right? Because see, if you look at a lot of funds, would do well if you look at long-term performance. There will be not much of a difference, but if able to do that consistently in every calendar year, I think that's something which we have tried to do in this fund, and that can come only from a discipline in terms of first of all, what kind of exposure you take in the fund at a sector level, right, vis-a-vis the benchmark, what kind of an exposure you take at the stock level. So we have this fund in its mandate, right, since the beginning, was the only fund, I think, in industry which has got certain guidelines around that, right? How much exposure, overweight or underweight, the fund can take vis-a-vis the benchmark weights, of a particular sector, right? So the idea is to generate alpha, because that's what everybody aspires to do that, but within a particular guardrail, so you don't take excessive risk for generating the returns, because that can lead to very high returns, in a particular period, but equally, when things are against you, it can also lead to significant drawdowns which are there. So that discipline is something which we have continued to maintain that in this fund. Secondly, is that the philosophy is for bottom stock selection, which over a period of time, which I have evolved, is that buying into companies, right, which are slightly growth oriented style, I would say, because I believe that India is a growth market, and you're able to identify companies which are growing faster say, than the industry in which they are. That means the companies are gaining some market share, or even on a broader basis, growing faster than the overall economy. Right? That's where value creation will happen. And then trying to buy them at a reasonable price. Right? So the growth at a reasonable price is the essence in terms of a philosophy of buying stocks in this portfolio. And that has, I think, stood the test of time across various periods, right? There are some periods, okay, where probably where it would not work. Like, for example, in calendar year 18 and calendar year 1920 until pre-COVID, it was growth at any price, right? So, which was there in the last 2 years, it was value which was doing well. But by and large, I think guard philosophy across a market cycle does well. And so that's been our kind of a process for identifying stocks. And I think over a period of time, one has realized that also that backing the right management is very important if you want to create long-term compounding in a stock. I mean, short term, you can, yes.
We'll just try and find out the other details that you have in the last 17, 18 years that you've been working with the fund. And I'll just help viewers with understanding how Mr. Patil has bounced back from, terrible times. This is the worst phase of the fund in terms of week, month, quarter, and year, ladies and gentlemen. Please pay attention to them. The worst week was when the fund fell 18.5%. Now, all these worst weeks were around the COVID time. The worst month was minus 36% fall. The worst quarter was minus 37%, and the worst year was minus 34%. Mr. Patil, in the last 19 years that you've managed this fund, there have been only two negative returns, one in 2011, down 23%, and one in 2018, minus 3%. How do you bounce back from such negativity?
Yeah, so I think there'll be periods, okay, where because of a market or some crisis, I think we'll see markets, okay, correcting sharply in a time frame. I think in those periods, I think the way I look at it is that any period, okay, of underperformance, say for the market, okay, or for the fund, is an opportunity, because that's a time, okay, where you get some mispricing in the market, right? Where there is fear in the market and stocks correct, and that's the time I think one undertakes some kind of a portfolio churn, right, to be able to get into stocks, okay, which have corrected because of for whatever market reasons and are available, okay, at prices, okay, where you see the stock is significantly below its intrinsic value. I think those are periods, okay, when the fund has given a large drawdown. We look at those opportunities in the market to identify those stocks which can benefit us, okay, when the fund bounces back, or when the market bounces back. Because invariably, I've seen that these periods of large drawdowns which are there in the market or in the funds, they don't last for long, right? So that's a period to really be bold and buy into the stocks where we have done our research, where conviction is high, but market action because of fear or because of some distortions, okay, gives make the stock available at a very attractive price. So I think that is an opportunity, in fact, which we look at, and that helps us to really bounce back, okay, when the recovery happens, and to even make up for the underperformance, if any, one would have during those periods of sharp market drawdowns.
Okay. Mr. Patil, when you look at the asset that you manage in this fund, it's about 30,000 crore rupees. It's pretty huge. And this is about spread over 81 stocks. I was going through the details of your top 20 holdings, and I realized that, this is a fund that hugs the Nifty or the Sensex very well. I think out of the top 20 holdings, about 15 or 14 would be Nifty and Sensex stocks. What do you think is the sauce, the secret sauce for creating long-term wealth generation? Is this sticking to the Nifty stocks where you know that for a fact that these companies would be there 20, 30, 40 years into existence, and of course there will be downturns, but over time their returns will beat average returns?
Yeah, so the way we look at this fund, right, the managers, there are three buckets to it if you look at it. One will be the benchmark kind of a sleeve, right, which are stocks which are there in the benchmark and which you would want to have because these are stocks, okay, especially the top 20 stocks in the benchmark, as you rightly said, right? So those are stocks, okay, which are companies which are well-established companies, okay, they have evolved over a period of time, and that provides stability to the fund. Obviously, you will take underweight or overweight positions within these top 20 stocks in the benchmark, depending on one's outlook. And that's where you try to generate the outperformance over there. But that provides the stability to the fund, right? The benchmark, which is there. Then the next part is, and this will typically, if you look at the top 20 holdings benchmark stocks, which are, they will account for almost like 50 to 60% of the fund at any point in time. Obviously, active weights will be a bit different. Then there is the core part of your portfolio, which is there, which are stocks, okay, which are your long-term bets, okay, where you are wanting these stocks will typically say double over the next, say, 4 to 6 year period is what we look at, and where we take active positions vis-a-vis the benchmark, and these are companies where they go through a certain framework, right, where a meet a certain criteria in terms of the return on capital, the free cash flow generation, management quality, and that really generates the alpha, right? And that is typically would be say around say another 25-30% of the portfolio which is there, and they could be kind of within the benchmark stocks. Okay, so like a benchmark in this case is the NSE 100. They could be outside top 20 stocks, or they could be some mid cap companies. We also take some exposure in the mid cap space, say around 10 to 15%. Okay, where we think the stocks can be a differentiator and generate alpha. And then another 20% of the portfolio is a tactical position, okay, which we take, right, which is stocks taking from a short-term perspective or a near-term perspective, which are there to really manage the short-term trends in the market, right, to capture those trends. So that's how the overall portfolio construct is done. But the 55-60% of the benchmark provides the stability, and I think as I said, the discipline of taking measured risk, okay, really comes from that, and that's the reason why the fund has been able to stand the test of time over a long period of time.
Okay. Now, this is, ladies and gentlemen, the return that I just want you to understand. Should you have invested 10,000 rupees in the beginning of August 2002 with Mr. Patil's scheme, you would have invested a total of about 26 lakh rupees for 26.4 lakh rupees, and that amount would have been 2 crore 43 lakh as far as that 10,000 rupee SIP was concerned. If this amount were just a simple 5,000 rupees over 22 years, you would have invested 13.2 lakh rupees, and they in turn would be 1.21 crores. So this is what CAGR of 19.77% does. Each 42 months, the money doubles. It is so easy to make money in the long term, but people are so sort of keen to do this in 1 week that they end up losing their capital as well. Mr. Patil, let's get deeper into the scheme that you manage. Are there some stocks?
Let me just add there. I think you made a
Yes.
wonderful point there about long term. So what happens, what we've seen is that while you have said this is the actual return of this fund or a long term compounding, you stay invested over there. But many investors come at various points in time, right? And
Yes.
they could possibly come and they exit also at the wrong point, and their experience is not that
Yes.
great. So I think it's very important to stick to a fund. Okay, if you believe that fund has good long-term track record, and to be with that, because then only you will be able to compound and reap the benefit. Okay, even when the fund is doing well and when the fund is not doing well, right? So, and that's a very important point which you highlighted.
Yes, Mr. Patil, I've been watching specifically your fund and many of our peers, which all of us speak to, and suddenly you realize, this of course is in hindsight after 25 years, that you could have spared 5,000 rupees or 10,000 rupees really early in your job and created this fantastic wealth by doing practically nothing and navigating almost through everywhere. See, the global financial crisis came in 2008. The the temper tantrum came in 2011. There were so many problems in terms of the demonetization and the GST allocation. And here is something that appreciates 20% year on year. One just needs to maintain the SIP and do practically nothing, and at the end of maybe 25-30 years, of course there's a long history even now, you would reap a windfall. I wish people would understand this simple logic and start even today. Mr. Patil is going to be there for the next 25 years also. So why not enjoy this wonderful CAGR that you see. Now coming to allocations as of now. The world is different, Mahesh ji, from the time you started in 2002 when we had the fag end of the dot-com bubble being burst, and today when the internet space is dominating our thought process. How do you read this space? I see one internet stock in your top 15, which is Zomato. Is this a space where you see long-term wealth being created from present levels?
So again, some of the new age technology companies, okay, which came into the market say around 3 years back, right? We saw a couple of them now coming into the listed space. I think we believe that okay, this is a space. Okay, these are companies which are high growth companies. These are companies which are disruptors. Okay, in that space, and obviously there is high risk associated with these companies because the numbers there, okay, are still kind of emerging, right? But I
Yes.
think clearly, I think India offers an opportunity, right, in the internet and the technology space, because I think adoption of technology in India has been fairly strong. Okay, we have the enabling network, and post COVID, we have seen that traction. So I think in this space, when we look to invest, we look at companies which have a very strong kind of a moat and have got unit economics in place, right? At the unit level, they are making profits, and they have established their leadership, right? Because normally in this space, I think if you're fighting for market share, then nobody makes money, right? So when fairly, I think the leadership has been established, unit economics are in place. I think that's when I think we would want to enter into that. And obviously, the overall TAM, the target market opportunity, should be very large so that the runway for growth remains very long, right? At least a 10, 20 years or so. And that's the filter through which we look at some of these new age technology names, and I think we build confidence, right? In the way we increase our exposure. So initially we would have taken a small exposure in such names, say around 0.5%. Then over a period of time, as the company is delivered and we get more visibility in terms of the cash flows and profits, we tend to increase. But clearly, I think India is a space which is the growth market. There are disruptors, and if you're able to identify these companies, can really create differentiated returns in one's portfolio.
Okay. Since you've assumed charge from October 2005, Mr. Patil, are there some stocks that have remained an integral part ever since you've taken charge? I'll repeat the top 5 stocks that are there in the scheme. They are HDFC Bank, ICICI Bank, Infosys, Reliance Industries, and Larsen and Toubro. Something that you may have invested from day one and it continues to be a part of portfolio even now.
Yes, so I think quite a few of the stocks, right, especially the large index bellwether stocks, right, would have been there in the portfolio. Obviously, their weightages would have changed over a period of time depending on their outlook. Okay, each stock goes through a certain cycle or a phase which are there. But apart from that, I think stocks like, for example, I remember in the early stage, telecom, right, was a sector, okay, which was a sector which was emerging at those point in time, 2005. Okay, now it's slightly more mature because I think that is one, if you look at Bharati, for example, in the portfolio would have been there for
Yes.
full period. And in that period, it went through a period where nothing much happened, right? Okay. And again, we have seen the telecom sector because of consolidation in the sector now coming through is and deleveraging happening is coming through. So I think there are certain core stocks in our portfolio which we like. There are, as I said, it's a core part of a portfolio, right? Which are companies which are secular in nature, right? I mean, they'll always
Yes.
be in the portfolio because of they're into good businesses, right? Good management, generating good cash flows, reasonable growth opportunity, and but but depending on their near-term outlook, okay, their weightages could change. I mean, unless fundamentally the business thesis in which we invest into changes, we normally would hold those stocks from long term and let it compound and generate wealth. So yeah, I mean, quite a few of the portfolio would be stocks which have been there, okay, for say many years.
Right. And specifically, the reason why I asked this question is that the top holding for Aditya Birla Sun Life Frontline Equity Fund is HDFC Bank, which is about 7.5% of 30,000 crore rupees in terms of assets. And we all know the pain and the how should I say, the flat returns that we've seen over the last 3-4 years. Yet, ladies and gentlemen, it continues to be the top pick, simply because stocks go through bad phases and they come back very strongly. Mr. Patil, would you still have hope and expectations from HDFC Bank to deliver market beating returns over the next 10 years?
So I would not talk about any stock specifically. I'll tell you the
Yes.
philosophy, right? How we look at it. See, one is, I think, while you look at the stocks in the portfolio, right, in terms of the absolute weight, I think what I look at is that the relative weight, right, of that stock vis-a-vis the benchmark, right? Because our end objective is to beat the benchmark by a reasonable margin, right? So the active weights, right? Active weight means how much underweight or overweight we are vis-a-vis the weightage of that stock in the benchmark is more relevant, because certain stocks will have a high weight because their benchmark weight itself is high, the relevance is much higher. But the way we approach some of these good quality stocks, right? I mean, a stock like, say, HDFC Bank, again, or whatever, some of these names are stocks which have been there for ages, right? They would continue to be there. So some of the good quality stocks or the market leaders stocks, we like it if they go through a period of underperformance, right? Okay, for a certain period of time because of certain factors. Okay, could be the various factors. It could be there. Right? It could be something due to the management change. Okay, either it could be due to some uh, kind of a short-term challenges the company could be facing, and some disruptions. Okay, could be there. So that's a time when we seriously start looking at this company, and we have to act sometimes counter-cyclical, right?
Yes.
See, for managing large money and large pools of money, we need to be slightly counter-cyclicals and being into early in stocks, okay, which have underperformed, but fundamentally there are good companies and good businesses, right? Because that's when you tend to get, and when everybody is slightly negative, there's
Yes.
under ownership in that name. That's where we seriously start looking into it and see whether this is the right time to really get into the stocks or increase the exposure. Are there going to be any triggers, okay, which could come in, which could now start to, start outperforming, and that's a kind of a counter-cyclical strategy, okay, which we would like to adopt, and we have done that in quite a few names, which have good names, which have gone through a 2-3 years of kind of a consolidation, and that's the time when we are normally able to buy these stocks at a say reasonable. Because normally a good company is always expensive, right? So we would,
Absolutely.
they will never get the right price. But when things are going through a short-term kind of a patch, okay, which is kind of negative, that's where okay you can buy them at a reasonable price, and then they tend to invert into bounce back like a good fund, right? As you said, right? In a down period, okay, it could if it's doing well, and it can again bounce back. Similarly, a good company will do that. So that's the underlying
Absolutely.
philosophy. I think counter-cyclical investing into good quality stocks is what I think has helped us, okay, to really build position in good stocks and overall maintain the quality of the portfolio.
Absolutely. I think somewhere in the late 1980s, all of India learned a wonderful line from Hindustan Unilever, which said, "Sasti cheez aur achhi cheez mein fark hota hai," and that has been pretty much true for Indian Dalal Street as well. Mr. Patil, just one point that I'd like to make. Since inception, which is August 2002, your fund has returned 19.77%. At the same time, the Sensex CAGR over the last 2 decades has been 17.62%. Are there any stock exits that you remember which were phenomenal and created huge wealth for your fund?
So, yeah, I mean, there would be quite a few actually, right? Okay, I mean, there are exits are basically stocks, okay, which are, you can say mistakes, okay, or fundamentally things have changed, right? Okay, over a
Yes.
period of time. And then sometimes the stocks go to their relevance is no longer there, right? What was relevant, say in 2005, 6, right? We saw in that period there were a lot of these construction companies which were there. I mean, that was a period of infra boom, right? We saw many
Yes.
infrastructure companies which were there, which came up and they gave very good returns, right? They are no longer there, right? Except for larger names, right? They are no longer there. So that is a period. Similarly, we saw in the real estate sector also at that period, there were many companies which emerged and they went through a kind of a down cycle in that period. And so I think there are companies, okay, where probably because of the business itself, okay, undergoing through a challenging period or a down cycle. More importantly, I think where we are exited companies are companies where the managements, okay, have serious disappointment or there have been corporate governance issues which are there. Right? And we saw that in a few companies which were there in our portfolio. I don't want to take the names over here, but there were some names, especially during the financial crisis when we saw, right, in India, right, in the NBFC crisis, which was in
Indeed.
2017-18 period, right, where we saw some of the banks and NBFCs went through a pretty
Terrible time.
bad phase, right? Phase. So those were the names, okay, where we probably erred in terms of the management, okay, which we are backing, and we took corrective actions over that. So it is always important to continuously look at your laggards in the portfolio and uh, uh, try to critically evaluate and remove them, because these are the stocks, okay, which are not only dragging the returns but also is an opportunity cost, right, of deploying some good money, right? So I think the sooner we realize the mistakes, I think the better it is, and that's what I tend to do normally. Stocks which tend to underperform, okay, for a period of time beyond a point. Okay, one, I would critically evaluate and see if something is going wrong in our thesis. And obviously, if there are any corporate governance issues, we don't hesitate to really exit that stock as quickly as possible.
Okay. Now comes the difficult questions, Mr. Patil. Are there some phases and are there some sectors or stocks that you regret not taking part into, rallies that you may have missed, which might have added a further colorful feather to what has already been a fantastic performance?
So I think, yeah, true. Actually, if you look at the recent, in the last 2 years itself, right, we have seen a huge kind of an performance in a few sectors. It's been a period where the divergence in the market has been the largest, right? So I think
Yes.
clearly one sector which I miss, which actually played out very well in the 2005 2008 period, was the industrial and the capital goods sector, right? Because that's a sector which has been one of the big outperformers in the last couple of years. Again, riding on the capex recovery in India and also in the power sector. While we had some exposure over there, but clearly, if we had a slightly larger overweight in some of the names, I think it could have made a significant difference in the portfolio, which has already been decent in the last 2 years. We have done fairly well, but that could have been the topping on that, I would say. Also, another sector is, or other theme, I would say, is the PSUs, right? So PSUs, again, we were the early ones, okay, to be positive on PSU. We launched, as a fund house, we launched a PSU fund around 4 years back, 5 years back, right?
Yes.
But again, we didn't expect this kind of a re-rating to happen in the PSU space, right? Especially in the last 2 years. And there are some good quality names in the PSU basket. Okay, we had major exposures in a few names in the utility space or in the energy sector in the PSU basket. But again, as you know, PSU returns in the last 1 year has been almost 100%, right? Whereas the Nifty return on the NSE return would have been around 25%. So I think probably some of these sectors, if we had been given larger allocation than what we had, obviously it would have, uh, in hindsight, okay, we would have probably done much better. But that's always the case, right? You are never
Absolutely.
able to really. But the good thing is that we're able to capture these upsides. So we had
Yes.
exposure, okay. In these funds, okay, in these sectors, okay, but not to the extent, okay, which can have given us extraordinary returns over there. But that's fine. I think, see, we always believe in generating alpha, right, in an incremental way, right,
Absolutely.
across, rather than, one, because that one theme can also go down, right, and it can, while it benefits you in that upcycle, if and it's very difficult to unwind that. So in a down cycle, again, we see then there is a large underperformance which is there. This is what we want to reduce, that volatility in our returns vis-a-vis the benchmark. And that's why we always tend to take measured overweights across this sector.
Right, Mr. Patil, this is the second time during the day I'm saying this lovely Hindi idiom which says किसी को मुकम्मल जहाँ नहीं मिलता कहीं ज़मीं तो कहीं आसमान नहीं मिलता. It's been a fabulous 20 years for Aditya Birla Sun Life Frontline Equity Fund, a CAGR of 19.77%. You rank second in 2 decades to create this phenomenal return. And I would not be doing my job if I don't ask the next question, which is, what do you expect the US Federal Reserve to do tonight?
I think one thing is directionally it is clear, right? That you will see a rate cut. Now, to what extent, okay, that would be, I think that's what the market would be guessing. I mean, 25 basis point is a given. Whether it will 50 basis point, I don't know. But I think clearly, I think the way things are shaping up in both in terms of inflation, right, and in terms of growth also, right, kind of slowing down. I think you are in a now a rate cut cycle globally, right, which is the market is expecting 3 rate cuts in this calendar year, right?
Yes.
So I think clearly, I think that will be there. And the good thing is that I think this time around, see, people always compare the earlier rate cycles when the rate cuts happened, right? Markets have seen a significant correction in the next 6 months. But those rate cuts were driven by crisis, right? Whether it was
Yes.
during the global financial crisis or whether it was during the after dot-com bust. This time around, it is, I don't see any kind of a crisis. It is more to control inflation, right? And which is also now getting under control. So I would say that this time the rate cut, obviously there will be some slowdown, right? There is a slowdown in the economy, but it's not going to be catastrophic. So by and large, I think it should be good for equity markets. Valuations are at one side. Okay, in the markets we've seen the valuations kind of zoom up because of especially in domestic markets. There are pockets, especially in the large cap. I still believe that the large cap space is still reasonably priced, slightly above the long-term average, and this and people have moved away from large caps or the large blue chip names, right? People are trying to take risk and take higher returns. But I think this is a time
Yes.
now to slightly consolidate because this is not going to last, right? The market breadth, which is at an all-time high, I think is likely to consolidate. So I think it's more to protect your return at this point in time. And a large cap category and a frontline equity fund will be a good fund to really participate in the growth as well as give some kind of I mean, you can sleep over it. Okay, much better is what I think.
And 42% of assets under management of Aditya Birla Sun Life Frontline Fund are with large caps. With that, Mr. Patil, this has been a wonderful 35 minutes learning to understand how your brain ticks and how you've managed this fantastic performance over the last 2 decades, which is a 19.77% CAGR of the fund. Thank you so much for your time, and it's been a pleasure.
Thank you, Mr. Bhatnagar. I think it was a pleasure talking to you and again going down the memory lane, right? So,
Yes.
yeah, pleasure. Thank you.
Good. It's been a pleasure at our end, sir, and I hope the viewers have enjoyed it as much as at least I have. Thank you so much for your time, ladies and gentlemen. Please stay tuned to Business Today Television. There's a lot happening in the market on this weekly expiry day of the Bank Nifty, where short sellers have been taken to the cleaners. Stay tuned.
WhatsApp is showcasing an experiential AI zone here. So let's find out and check out all the new features that WhatsApp has to showcase. But first, let's discuss what's